Hello and welcome, everyone. My name is Cam Leung, and I'm a principal at the International Ethics Standards Board for Accountants, IESBA for short, and I'm the moderator of today's webinar on the revisions to the non-assurance services to the IESBA Code of Ethics. I'm very pleased that over 400 professionals have joined us today from all over the world. Let me first start by introducing our presenters, Ms. Kim Gibson and Mr. Richard Fleck, who are both members of the IESBA's Non-Assurance Services Task Force, which we'll refer to as NAS for short for the rest of this webinar. They participated in developing the revisions to the NAS provisions of the IESBA Code of Ethics. Kim is the Global Head of Independence for Grant Thornton International and a partner with Grant Thornton in the US. She is a member of the IESBA and chair of the NAS and Fees Rollout Working Group. Richard is a consultant and former partner at Herbert Smith Freehills, a UK law firm. He currently is a chair of IESBA's Long Association Post-Implementation Review Working Group and was the past deputy chair of the IESBA and chair of the NAS Task Force. Today, Kim and Richard will present us the key changes to the NAS provisions of the code that will come into effect in December 2022. Welcome, Kim and Richard, and thank you very much for joining us today. Now, before we start the presentation, I would like to walk you through some house rules. The first is, if you have any questions at any time during the session, you may submit them by using the question box in your GoToWebinar control panel. Kim and Richard will answer as many questions as time allows at the end of the presentation. The second is to please note that this webinar event is being recorded and will be posted shortly today on the IESBA website. This means that you will be able to access it later and share it with your colleagues and network. The link to our website is available in the chat box function in the GoToWebinar control panel for your easy access. Next slide, please. So today's presentation will focus on the four main areas as outlined on the slide. Kim and Richard will be presenting on different topics respectively. Now, without much further ado, I will pass it up to Richard now, who will present first. Thank you.
Good morning, everyone. I hope you could hear me all right, and perhaps we could have the next slide. Thank you. So we're going to try and cover the significance of the changes that have been made over the past in these revisions. And we're conscious that we're doing this against a backcloth where the code already provides, in our view, a strong foundation, but where more is required. And we're also conscious that there's been a desire to avoid multiple revisions to the code. But nevertheless, because of increasing concerns about the effect of NAS on independence, the provision of non-assurance services on independence of auditors, and changing public expectations, it's necessary for us to move on and check that what we have at the present is appropriately up to date. And those expectations, the public expectations, have been increased by developments such as the European regulation and changes to laws and regulations in different jurisdictions. This particular project was approved in September 2018, and we completed it in a 2-year period, as we will see. Next slide, please. Now, one of the very important things to focus on in the course of this discussion is the fact that we differentiate between public interest entities and non-public interest entities. Public interest entities, as the name suggests, are those entities that affect society and are in practice in the forefront of the minds of regulators and politicians. By the same token, non-PIEs are a very important driver of national economies. But individually, they don't have the same impact on society as a whole. And therefore, the code takes different approaches to public interest entities and non-public interest entities. Now, obviously, this makes the definition of a public interest entity very important. The current definition is being reviewed, and there's an exposure draft has been published, and all things being equal, there will be a revision to the definition by the end of this year. So this is really a case of watch this space. This is an important aspect that should not be left out of your consideration of the impact of the revisions to the code and how you respond to them. Next slide, please. So in developing the proposals that we have that were approved in December, we had an extensive consultation. We undertook roundtables in Washington, Paris, Tokyo, and Melbourne in 2018. And we developed over the following year the exposure draft, which was released in January 2020. We had lots of comment letters, lots of interaction with interested stakeholders, and at the end of that, approved the revisions last December. And the very important point for you to note right now is that the effective date is December 22. So you've got effectively 18 months before these provisions take effect. Next slide, please. Now, this slide focuses or tries to give you an overview of the sections of the code that are affected by the revisions. First and foremost is section 600. That's the key aspect or part of the code that's affected by these revisions. Sections 601 to 627 have been significantly expanded, and that's the general section that applies in all circumstances. And I want to repeat that. Sections 600.1 to 627 are applicable in all circumstances. And the subsections 601 to 610, which are topic specific, as it says on the slide, or more specifically, address particular categories or types of non-assurance service, provide additional guidance to be taken into account when assessing the appropriateness of the provision of the non-assurance service. So whenever you're looking at the subsection, always remember that the general paragraphs in 601.1 to 627 are always applicable. There are also consequential amendments to section 400, 525, 900, and 950. Perhaps I just mention two of those. 400, there's an important amendment in that the prohibition on assuming management responsibility has been moved from 600 to 400 to apply generally across the whole of the relevant part of the code. And 525 deals with situations where loan staff is provided, but that's a very specific and narrow point. So next slide, please. So the key revisions, the ones that really are most significant in terms of change and effect, are first, the introduction of a prohibition on the provision of non-assurance services that might give rise to a self-review threat where the audit client, is a public interest entity. So it's the introduction of a new self-review threat prohibition for PIE audit clients. The second, the purple or mauve box in the middle, is a number of requirements, number of paragraphs that address what audit firms have to do when they are proposing to provide non-assurance services to public interest entities, and the steps they must take to communicate with those charged with governance or the audit committee, as the case may be, to ensure that they are content that the independence of the audit firm will not be affected by the provision of the proposed non-assurance service. As Kim will explain, that discussion with those charged with governance has to take place before the service is provided. The third area of development or change is that in the right-hand box, and the key point here is that we've taken every opportunity to help practitioners, to apply the conceptual framework appropriately when considering whether to provide a non-assurance service to an audit client. So wherever possible, we have tried to take people through the thought process that should be followed in identifying, evaluating, and then addressing whatever threats may exist as a result of the provision of the non-assurance service. And self-evidently, if there's a prohibition, that solves the problem. And if there is not a prohibition, then the important point to note is that the safeguards put in place must address the threats and reduce them to an acceptable level, or the provision of the non-assurance service should not proceed. So let's start with the self-review threat prohibition. So next slide, please. The key point here is that research has shown that the biggest threat to auditor independence comes from the provision of non-assurance services that give rise to a self-review threat and which therefore impacts the way in which the audit is affected. Now, to a very large degree, this is an issue of appearance rather than reality. But we all know that if there is a lack of independence by appearance, that undermines public confidence and impacts the confidence in financial reporting and the performance of the audit and the audit function. So to ensure public confidence, IESBA concluded that the provision of non-assurance services to public interest audit clients should be prohibited. And they did so because they were satisfied that the threat cannot be eliminated or reduced to an acceptable level by applying safeguards when it comes to issues of appearance. Although it might be the case that one could reduce the threat as a matter of practice, or indeed it might not undermine confidence in the independence of the audit firm, the reality, as a matter of fact, the reality is that the threat to independence of appearance is very great. And that was the conclusion that IESBA reached. It was the conclusion that it consulted on and which was accepted by consultees. And it's on that basis that the prohibition was put in place. So how do we go forward in the light of that prohibition? Next slide, please. Well, the starting point is to determine whether or not there is in fact a threat, a self-review threat that might arise as a result of the provision of the non-assurance service. And that step needs to be taken whether one is auditing a public interest entity or a non-public interest entity. And the question one needs to ask oneself is there a risk that the proposed non-assurance service might create a self-review threat? And the answer to that question depends on the answer to the two questions or points set out in the bullets on this slide. Will the results of the NAS form part of or affect the accounting records on which the firm will express an opinion? And that's an important word, and in the course of the audit of those financial statements, will the firm evaluate or rely on any judgments made in the course of providing the non-assurance service? And if you get the answer yes to both those parts, those points, those questions, then there is a risk that a non-assurance service will be, a self-review threat will be created, and the non-assurance service should not be provided if the entity is a PIE. I'll come back in a moment to what the position is if there's a non-PIE. Now, in the little box to the right, it said that it's irrelevant whether the non-assurance service will be subject to audit procedures or if the outcome is material. The point here is this: one cannot avoid a positive answer to the questions that form the bullet points on this slide by relying on materiality and saying, well, it's not material, therefore we won't undertake any audit procedures in relation to it, or by designing audit procedures which avoid the need to review the non-assurance work. For example, by deciding that a component entity is so small it doesn't have to be looked at. Those judgments or those steps are not ways in which you can, so to speak, get the right answer to enable you to provide the non-assurance service. Next slide, please. Now, there are two aspects of this that were the subject of very considerable discussion. The first is the use of the phrase in the provisions, might create. A number of people thought that it should say will create. We at IESBA concluded that it was very important that the text referred to the possible creation of the threat and therefore used the terminology might create. And that's because we wanted the prohibition to be triggered as soon as the possibility of a self-review threat is identified. We did not want the prohibition to only apply if there was clarity, certainty that the self-review threat would be created or will be created. And that's all part of trying to avoid mistaken assessments and audit procedure judgments that would have avoided the self-review threat and other such approaches, which might in turn then prove to be wrong or result in the work needing to be done and the work relating to the non-assurance service to be reviewed, with the result that the firm would no longer be independent and there would be a serious breach situation to be addressed. So the whole purpose of the language that's been used is to avoid situations where a breach might occur through a mistaken judgment or because what was thought to be the appropriate approach when developing the audit plan changed. And similarly, that is the same thought process applied in respect of materiality. We did not want decisions on materiality to prove to be mistaken because actually the issues were bigger than had been appreciated at the outset, and then find that the non-assurance service jeopardized or compromised the independence of the audit firm. The approach that we've proposed achieves, we believe, consistency in application and should avoid problems down the line. Next slide, please. I said that I would turn and address the position of non-public interest entity audit clients. So having identified a self-review threat, having applied the two tests that we talked about earlier, if the entity that's being audited is a non-public interest entity, then the conceptual framework applies. The prohibition does not apply. And if the conceptual framework applies, and having identified the self-review threat, the responsibility of the auditor is to evaluate the level and nature of the threat, to consider what safeguards might be appropriate. And in that context, we've provided some additional examples of how safeguards might help. And if those safeguards would work, then all well and good. You apply the safeguard and proceed to provide the non-assurance service. And if the safeguards will not reduce the threat to an acceptable level, there is no alternative under the conceptual framework but to decide that one cannot proceed to provide the non-assurance service. So very simply, for a non-PIE, having identified a self-review threat, one evaluates that threat, considers the safeguards, potential safeguards, whether they will reduce the threat to an acceptable level. All well and good if they will, but if they won't, you should not provide the non-assurance service. And I hope that's a reasonably clear explanation of the way in which self-review threats should be addressed, whether you are a PIE or a non-PIE audit client. Next slide, please. I'm next going to turn to the issue of advice and recommendations. It's a fact of life that the provision of advice and recommendations can relate to matters that may subsequently be the subject of consideration in the course of an audit. There are lots of examples. You may give advice about controls, about tax, about accounting treatments, about accounting frameworks, and all of those situations might give rise to a review of the advice given in the course of the audit. So it's very important when contemplating or being asked to provide advice and recommendations that one considers what the existence or the potential existence of self-review threats. So one always needs to keep this in mind when helping clients, and we all understand the importance of being able to help clients when one can, but this is a cautionary word not to avoid doing so if it's going to give rise to a point. Let me just pause there to draw your attention to one thing on this slide, which is at the bottom right-hand corner of the page. It says there, click here for a 3-minute video to learn more. When you receive all of these slides, you will, I hope, be able to implement this and click as instructed. And what that will do is give you an additional video on the specific subject matter of the slide. You'll find this on the number of slides that are following. So next slide, please. Now, the significance of the comments I've made about advice and recommendations isn't so great for non-public interest entities, because obviously there's no prohibition. But in the case of public interest entities, the prohibition would, on the face of it, preclude the provision of advice and recommendations to public interest entity audit clients. But we didn't want to prevent firms providing advice that arises out of the audit or rises from matters that they learned in the course of an audit. And so we've provided a specific exemption to permit the provision of advice and recommendations to public interest audit clients, provided, and these are the 2 points on the right-hand side, provided that the firm doesn't assume a management responsibility, and provided the firm does think through the independence risks arising from other factors, be it self-interest, etc. So where a request or the provision of advice and recommendations arises out of matters that arose in the course of an audit, you apply the conceptual framework and the code's general prohibition on assuming management responsibility. Next slide, please. And I'll take this quite shortly because we've really covered most of this already. There is a specific provision in the code, 600.10, that says that where the code expressly prohibits the provision of a non-assurance service to an audit client, whether it's a public interest entity or a non-public interest entity, that prohibition applies regardless of any argument based on materiality. So as long as the prohibition is expressed to be unqualified, it is unqualified in all respects, and there is no continuing relief for what might be regarded as an immaterial consequence. And you'll find that that gets repeated in a number of places as we go through other aspects of the code. But the point I want to emphasize is, if there is a prohibition, you cannot avoid it by arguing or assessing the risk as immaterial or immaterial to the accounts. So with that, I will pass you over to Kim. Thank you very much. Over to you, Kim.
Thank you, Richard. Hello, everyone. I'm happy that you're all able to join us today. I will start with discussing a topic that Richard mentioned, which is the firm's communication with those charged with governance. Along with the self-review threat, this communication really is one of the other cornerstones of the NAS revisions. Much of the communication requirements is based on the extant code, and the new requirements are an attempt to enhance and strengthen those communications. And what it really does is introduce a two-way dialogue between the audit firm and those charged with governance of the client. The requirements here include, the requirements are subject to approval or concurrence by those charged with governance. And this must take place before acceptance of any NAS service. So as you can see here on the slide, the left hand shows parent PIE audit client and downstream controlled entities. Before a NAS is accepted for any one of these corporate entities, the auditor must do the following. They must inform, they must provide, and they must obtain. So first, they must inform those charged with governance that the provision of the NAS is not prohibited by the current standards and will not create a threat to independence. If in fact a threat has been identified, then the auditor must inform those charged with governance how that threat can be brought to an acceptable level. The auditor must provide to those charged with governance information to enable them to make an informed assessment about the impact of the service on the firm's independence. And information that can be provided can include the nature and scope of the services, the proposed fees, and as I mentioned, any identified threats and how those threats can be either eliminated or brought to an acceptable level. Then the firm needs to obtain concurrence from those charged with governance that they agree that the provisions of the NAS will not impair independence. This is very important. So again, the firm must obtain concurrence from those charged with governance of their PIE audit client that they concur that there is no impact on independence. As you may be aware, many jurisdictions around the world have a similar concept, basically referred to as the pre-approval process. The IESBA was also cognizant of the fact that many PIEs can be quite complex in nature. They can be multinational, private equity groups, and this type of communication, because it really is information regarding the NAS above the audit client, may be difficult to manage in complex corporate structures. So there is the opportunity for the auditor and those charged with governance to agree on a process to be put in place to help facilitate the informing, the providing, and the obtaining of concurrence. And this type of process can include an agreement on how concurrence will be achieved. Will it be engagement by engagement or potentially a general policy on concurrence? Which corporate entities should be covered under the process? Identify any services that can be covered under the process. So more likely than not, it would be services that are allowable for PIE audit clients, and also who in the organization has the authority to approve any services. Next slide, please. So this slide here, the first box, I just went through some of the examples of information that can be communicated to those charged with governance. Again, nature and scope of the services, fees, identification of any threats, and also whether there is potentially a combined effect of multiple services that may create threats to independence. But what's really important here on this slide is the second box. In some instances, the firm's ability to provide appropriate information to those charged with governance about a NAS provided primarily to the parent may be restricted. And it can be restricted for various reasons. It can be via professional standards, confidentiality, laws and regulations. So when these types of situations arise, the code does have an exemption, and it will allow the firm to provide those NAS to the PIE audit client if the firm provides any information that it can disclose to those charged with governance, if the firm confirms to those charged with governance that there is no independence threat created as a result of the services, and those charged with governance do not disagree with the conclusion. So what that means is a firm is not permitted to provide the required communication if the firm cannot provide the required communications to those charged with governance for various reasons, confidentiality for one, and those charged with governance disagree with the firm's conclusions regarding independence, the firm must either, one, decline the NAS, or two, end the audit engagement. This section is very important. The entire section on those charged with governance is really a communication with those charged with governance is really essential for all stakeholders, audit committees, firms, to really understand these requirements. As we mentioned earlier, they are one of the most critical provisions of the new standards. Next slide, please. So similar to the extant code, the revised NAS provisions acknowledge the need for compliance with the code's conceptual framework and the general NAS provisions that Richard talked about earlier. As discussed in section 600, new business practices, the evolution of financial markets, and changes in technology make it really impossible to draw up an all-inclusive list of NAS that can be provided to an audit client. The board, the IESBA, believes that although the use of technology may have created certain new services and different scenarios, that the overarching principles in the code, primarily in the conceptual framework, remain relevant, and in addition to the revised NAS provisions. We believe that using the conceptual framework along with the new revisions really does provide useful guidance for firms to use, especially when trying to assess topics or services that are not explicitly detailed in the code. Next slide, please. Now, unlike the extant code, the revised NAS provisions enable the firms to consider how the NAS will be provided. So for example, how does the location of personnel impact the service to be provided? And how can technology be used to deliver various services? Next slide. And just to continue on a bit more with our technology theme here, there is much more technology on the horizon for the IESBA. There is a dedicated working group along with a task force that is looking at various work streams that include, as you see here, the development of non-authoritative materials focusing on technology changes that may be needed in the code itself, and the board, the task force and working group continue their outreach to stakeholders and technology professionals. Technology will continue to be a focus for the IESBA through 2021 and most definitely into 2022. Next slide, please. Thank you. So One of the goals, as Richard mentioned earlier, of the IESBA and the new standards is to drive consistency in application and implementation of new standards. This includes various changes that we have made to the code, including structural refinements to be reflective of the code structure that was put in place a few years back, along with proper placement of requirements and topics. Richard mentioned early on that we have now repositioned the management responsibility requirements that were previously in section 600 to section 400, as looking at assuming a management responsibility was determined to not necessarily be a NAS and really did not belong in 600, that it was applicable to all audit engagements, and as a result, it was moved to 400. We also elevated the requirement, elevated to a requirement, the application material regarding the consideration of the combined effect of providing multiple services to the same audit client. So previously, this was application material in the extant code, has now been moved up to a requirement. It does also include new application material, which provides factors that are relevant for a firm's evaluation of the threats when multiple NAS are provided. We also expanded examples of safeguards that can be considered when providing certain NAS. Again, Richard touched upon this when he talked about non-PIEs and when threats are identified for non-PIE audit engagements. There also has been a change in the sections 601 through 610, where in every introductory paragraph, the threats that have been identified as a result of those services are outlined and detailed right in the beginning of the section. So the user of the code will know immediately what type of threat that they are facing and that the service potentially could provide. There's also new documentation guidance in relation to the conclusions reached when complying with section 600. Next, thank you. So this slide really lays out some of the NAS prohibitions. The top half of the slide talks about the various prohibitions that have been included for all audit clients, both PIE and non-PIE. And the bottom half are the various services that the prohibitions have been included for PIE audit clients. For all clients, we have recruiting services, various certain tax services in subsection 604, and then for tax advisory and planning services and corporate finance services, where the effectiveness of the service depends on a particular accounting treatment or presentation in the financials. These are new prohibitions for all audit clients. On the bottom, with respect to the PIEs, there are prohibitions now for accounting and bookkeeping services, valuation services, acting as an expert witness, legal advice, and acting in an advocacy role. So if we can go to the next slide, please, Astu. I'll start off with the recruiting services, and then I will hand over to Richard to address the bookkeeping and tax services. So with respect to recruiting services, as many of you may be aware, with the Safeguard project from a few years ago, we introduced prohibitions for all audit clients for recruiting services. This includes PIE and non-PIE audit clients. The new revisions from from the new NAS provisions really do tighten those restrictions, again, for all audit clients. The additional prohibitions pertain to services that relate to recommending the person to be appointed and advising on terms of employment, compensation, related benefits of a candidate. So there is a prohibition for recommending a person and advising on the terms. And these prohibitions are specifically for positions where there would be a director or officer of the entity, or where a member of senior management is being placed, and that senior management can exert significant influence over financial statement preparation. In other jurisdictions, the term financial oversight, reporting oversight role is often used, so you can equate the director, officer, and senior manager, senior management person to the financial reporting oversight role. The prohibition, however, does not preclude an auditor from providing general assistance to the audit client. So this could include advising on the job description. It also can include reviewing the professional qualifications of a candidate. Consistent with the Safeguard Project, the prohibitions are really focused at prohibiting a firm from taking on management responsibilities when providing recruiting services. So with that, I will hand it over to Richard for tax services and accounting and bookkeeping. Richard?
Thank you, Kim. Hopefully we have the next slide. Thank you. I'm conscious that we want to be able to give you time for questions and answers, so I'm going to be quite brief over the next few slides. The position in relation to tax services is, as you will all be very well aware, that there are many different types of service, and each of them gives rise to different issues. In the code, there are two instances in which an auditor is prohibited from providing tax-related non-assurance services to an audit client, irrespective of whether it's a public interest entity or a non-public interest entity. The first is when you are promoting a plan that's been developed to reduce tax, and you're basically selling a tax product, and it's based on the firm's own research and opinions and assessment. And the second is where, as Kim has just said, the effectiveness of the advice is dependent on the accounting treatment and the audit. There are two circumstances where a firm is prohibited from providing a non-assurance service to a public interest entity. That's when you calculate, undertake tax calculations in order to prepare accounting entries, it should say, such as deferred tax entries and so forth. And the second is that firms are prohibited from acting as an advocate in the resolution of a tax matter for an audit client. And that's based on advocacy, as you will appreciate, rather than self-review or any such other argument. There are three circumstances when the code identifies the potential for a self-review threat. That's when you're giving tax planning advice, or you're handling valuations, or you're providing assistance in relation to a tax dispute. And in those circumstances, a careful evaluation of the risk of a self-review threat needs to be undertaken. And then for clarity, we do not believe that the preparation of tax returns gives rise to a self-review threat or other reason for that to be prohibited. Next slide, please. The next area that has been very topical has been the provision of accounting and bookkeeping advice or assistance to clients. It's a difficult area because the provision of accounting and bookkeeping services is thought by most to be uncontroversial, but in reality, the provision of those services risks undermining the audit client's responsibility for the financial records and financial statements, and it gives rise to a self-review threat because when the audit is undertaken, it's those bookkeeping entries which will be the subject of audit. So the position we've taken in the revisions is that for public interest entities, accounting and bookkeeping services are prohibited, and the existing permission to provide such services, if they are routine and mechanical, is withdrawn. In relation to public interest entities, there is one exception, and that's set out in the box to the right, which is if you are preparing financial statements for related entities, but that is only in very specific circumstances and subject to very specific conditions. One of which is you don't assume a management responsibility, one of which is that you are that the group accounts have already been completed, and one of which is that the statutory financial statements you prepare will not form the basis of future group accounts. So you need to look very carefully at those 6 conditions, all of which must be satisfied. Next slide, please. So that we also look carefully at the definition of routine and mechanical or mechanical services. What does that mean? And I think I could do no better than just draw your attention to the guidance on the right-hand side, that those are services that involve information or data where the client has made any judgments or decisions that might be necessary, and where the service being provided requires little or no professional judgment. We're talking about situations where you are applying some predetermined assumptions to some data to work out a cost or a figure, and simply computing the outcome. So routine and mechanical should be viewed through a strict lens, focusing on the client making the necessary judgments and the work involving little or no professional judgment, preferably none. Kim, I'm going to pass it back to you to do the last few slides before question and answers.
Thank you, Richard. I'm keeping an eye on the clock, hoping that we can end to be able to get a question or 2 from everyone. So let's see if we can get through these slides. The next service we want to talk about are valuation services. And there really hasn't been any significant changes to the requirements in valuation services. Basically, if it's a PIE audit engagement, you cannot provide valuation services. And if it is a non-PIE, the valuation service cannot be material and also cannot involve a significant degree of subjectivity. The code in paragraph 603.4A1 provides some guidance as to what a significant degree of subjectivity is. I will refer you to that paragraph, but basically it comes down to, will the results of evaluation performed by 2 or more different parties have a result that is not materially different? And that is really what we're looking for when we talk about significant degree of subjectivity. Again, that's for non-PIE only. PIE engagements, no valuations. Next slide, please. Okay, acting as an expert witness for PIE clients. There are new provisions in this area with respect to acting as a witness. The code prohibits a firm from acting as an expert witness in a dispute involving an audit client that is a PIE because an advocacy threat is created, unless the firm is appointed by a court or tribunal because because the firm has a duty to the court first as opposed to the audit client, and in certain situations where there is a class action lawsuit. So in order to be allowed to provide witness expert testimony in a class action, the firm's audit clients in their totality cannot be more than 20% of the class or group. No audit client can lead the class or group, and no audit client can determine the nature, scope, or terms of the service. These are new prohibitions included in the code as a result of the expert testimony. Next slide, please. Legal advice and acting as an advocacy for all firms, and then specifically for PIEs. So in relation to acting in an advocacy role, new application material for PIEs and non-PIEs explains that negotiating on behalf of an audit client might create an advocacy threat or might create a management responsibility. And then specific to PIEs, specific to PIEs, there is a prohibition from acting in an advocacy role in resolving a dispute or litigation before a tribunal or court. So there is a prohibition for advocacy roles for PIEs. With respect to legal advice, similar, there is new application materials for both PIEs and non-PIEs that provide examples of legal advice that might create a self-review threat, and that's 2 bullets there on the screen, and you could be referred to R608.7. And then specific for PIE audit clients, there are prohibitions of legal advice when a self-review threat might be created. So going back again to the conversation that Richard led regarding prohibitions for PIEs when a self-review threat may be introduced. Next slide, please. Okay. Section 950, it's a section that isn't often talked about, and I think there is a select clientele of practitioners that use Section 950, but Section 950, there have been conforming changes to reflect any changes necessary as a result of some of the changes in Section 600. There continues to be the alignment from Part 4B 950 to Part 4A 600, so that is preserved. Their amendments to Section 950 mainly include new guidance materials, application materials provided for assurance clients that are PIEs. And I won't go into the specifics here, but it's important to note that 950 really has not been touched as a result of this project, because the NAS initiative really is to focus on concerns of independence, firms' independence when providing non-assurance services to audit clients. Next slide, please. Okay, there is quite a lot of activity happening at IESBA with respect to rolling out these standards, the non-assurance services standards, and also the fee provisions. And hopefully some of you joined the webinar yesterday that detailed much of the fee provisions. So there is a dedicated website, which you can see on the slide, ethicsboard.org, strengthening IIS. And there are quite a lot of resources available for you to use. Obviously, the standards themselves. There are the bases for conclusions. There is an infographic, which is a one-pager that shows the highlights of both the NAS and fees provisions. And as Richard mentioned, there are YouTube videos. There's 10 plus videos that have been made by board members, primarily board members, and that touch upon various topics such as materiality, self-review threat, in the fee arena, fee transparency and dependency. So a lot more happening in this space. So I would, as you can see here, we're going to be having fact sheets, FAQs will be drafted. There will be links to this webinar and others, and of course, any articles that may be published on the topic. So please visit this page as often as you can. You will continue to see new material being provided and placed on the page. Next slide, please. And I believe this should be coming in Q3. It will be an update of the summary of PIE audit client prohibitions. Many of you may be familiar with this document. It lists out all of the prohibitions for PIE audit clients and will need to be updated to highlight the new provisions, the new general provisions, as well as the specific code section prohibitions. And it will also emphasize will emphasize that materiality is no longer a consideration when assessing independence. So with that, Cam, we have 5 minutes, it looks like. Hopefully I didn't rush through that. I will turn it over to you for questions.
Thank you, Kim and Richard. It was a very, very informative presentation. And also thank you to the participants for submitting so many questions. We have a couple of minutes, as Kim pointed out. So I've picked a question from the question box. So this is in relation to the self-review threat prohibition. The participant asked, how does the prohibition apply to related entities of a PIE audit client? So that's the upstream and downstream related entities.
Shall I try and deal with that, Cam?
Yes, thanks, Richard.
So first off, all downstream entities will be caught. In other words, if the non-assurance service is being provided to the any downstream entity, any controlled entity, then the prohibition would apply if a self-review threat is identified. As far as a parent is concerned, the same is true, but it will not apply to entities under common control and the like. In those circumstances, paragraph, I think it's R420 applies, which requires the firm to assess the position in the light of the proposed service and the potential impact on the audit client, and then make a decision from there.
Thank you, Richard. We have 3 minutes, so I'm going to try and squeeze one more question in.
Cam, it's Kim. Can I just add to that? I think it's important, in addition to the brothers sisters that Richard referred to, if there are services being provided to the parent, it is important to look in section 400. I don't have it in front of me, to look at, I'll call what's the subject to audit exemption. And it lists out various criteria that the auditor needs to look at with respect to the services. Primarily, will they be part of the audit engagement? Will they result in the self-review threat? So there are bullets, I'm sorry I don't have it in front of me, that that practitioners need to look at to ensure that they would meet that exemption if providing services above. As Richard noted, downstream is a different story.
Yeah. Okay, thank you, Kim. So I'm going to take one more question with the 2 minutes, and this is on those charged with governance. So the question was, in a case where we audit a subsidiary but not the parent, how in practice can we go and inform those charged with governance of the subsidiary if the parent does not allow any disclosures given the confidentiality aspects?
Perhaps I can take that. I'm just going to see if I'm muted or not. Okay. As we discussed earlier, the code acknowledges that it may in fact be difficult to obtain the information necessary from a parent entity for various reasons, confidentiality, law and regulations, etc. And the code does lay out what needs to be done in order for the firm to provide those services. And in certain situations, if in fact the firm is not able to provide the information that those charged with governance needs to make the assessment regarding independence, the firm will either need to terminate the audit or not accept the non-assurance services. So again, in that section, it's very clear as to what needs to be done if in fact there are these situations, but you very well may run into situations where the information just cannot be shared and those charged with governance at your client are not comfortable in concurring with the auditor's independence assessment.
Kim, it's important to add, if I may, that
Yes.
Of course, if you put a process in place that says it's fine to provide services to a parent in respect of brother and sister entities and other things like that, you may have pre-clearance situation which enables the service to be provided without any difficulty. So it's very important to think ahead about what sort of services would not cause a problem and perhaps put in place a process with those charged with governance so that applies.
That's right, Richard. Very good point. And as far as brothers sisters go, I know the question was specifically to subsidiaries, but brothers sisters, there is a paragraph that talks about anything that may come to your attention. So brother sister is a bit different of a requirement, but again, it's all laid out in the code in the section regarding communications, those charged with governance.
That's 420, yes.
Thank you.
Okay. Thank you, Kim and Richard. Unfortunately, we've come to the end of our session today, very tight timing. I wanted to thank everyone again for submitting the questions. We are developing a FAQ on the revised NAS provisions, so your questions will be considered in the development of this FAQ as well, so don't you worry. So thank you once again, Kim and Richard, for the excellent presentation, and thank you everyone for joining us. I want to remind you that this webinar was recorded and that all available supporting resources are on the IESBA website. The link which is in the chat box as well. Thank you and have a wonderful rest of the day. Goodbye, everyone.
Thank you. Thank you all.
Thank you.